Hi, everybody. Thank you for joining this week's 1031 exchange replacement property overview, specifically on the DSTs, the Delaware Statutory Trust properties, how we utilize them for 1031 exchanges. Before I dive into today's webinar, just want to do a couple quick housekeeping items. We are not here to provide tax or legal advice. Every investor situation is different. If you have specific questions from your CPA or any information that we could provide you for you to take to them, we can definitely do that. Definitely talk with whomever your team is here at K Properties. But just want to let you know as we go through this webinar that as we give, hypotheticals or any examples that, your particular situation could be different. In addition to that, DSTs, these vehicles are only available to accredited investors, which generally is somebody that has a net worth of $1 million or more, excluding their primary residence, or if it's an entity, so something like an LLC, a partnership, or a trust, any other entity, it can be accredited by two ways. Either all of the underlying owners are accredited investors individually, or the entity itself has gross assets of $5 million or more. If you do have an entity that is irrevocable, there are ways to accreditate that, but please definitely let us know or your team if you're going down, the DST route, that if it is an irrevocable trust, we want to dig a little deeper before to make sure that it does qualify. So other than that, as we go over who K Properties is, the different types of investments, I do always like to say at the end of the day, there's underlying real estate inside of the DSTs. And our goal here is to, walk you through the each DST as you dive deeper with K Properties and investments. No DST is, guaranteed. I've heard people, advisors out there, guarantee the income or say that it's a guaranteed income by a certain entity. At the end of the day, regardless of if it's a lease guarantor of any magnitude, there's always risk that that lease guarantor could go out of business. And so it's really important to understand, just like any real estate that you or I own on our own, there's always risk layers. And that's why we really dive into your situation, understand if you have a debt, what kind of debt you are required to maintain, what your risk tolerance is there. We diversify you, don't put all your eggs in one basket to mitigate potential risk factors. More importantly, every single one of these investments will have a full, what we call a PPM, a private placement memorandum, which will go over all the details of the particular investment offering. So here at K Properties, we collectively have over 340 years of real estate experience. We've, helped, this might be a little bit of an old stat, but well over 2,200 clients purchase over 9,000 DST investments. Again, I believe we're much higher than that at this point, but being involved in over $39 billion of DST offerings, it really has allowed us to have exposure across the United States to understand different asset classes, different sponsors, different areas of the country, different, everything kind of can move through different cycles. Some cycles move together. COVID, it affected some asset classes, it didn't affect others, or it affected certain asset classes in certain geographical areas, but not others. And so that's why the diversification is important, so that when there are black swan type events or things that are, not predictable or controllable, that you potentially have that risk spread out. And again, having clients invested in over $39 billion of these types of investment vehicles, we get, quarterly reports and annual reports on all these properties, and we can kind of get we have a pulse on the market per se. And again, it doesn't guarantee anything, but it at least gives us, an opportunity to potentially mitigate the controllables. But as we know, there's always uncontrollables in any investment vehicle. So diving in, just a quick recap of what the 1031 exchange is. Ultimately, for anybody who's new to this, it's a tool that's been used for 100+ years to defer your capital gains and recapture tax, depreciation recapture tax. A lot of people forget about that one. They calculate in their math that, oh, we just have this capital gain, let's just pay our tax, and then they discover they have a bunch of recapture tax. And so really talk with your CPA to understand your full tax burden. The other neat thing as you're exploring with your tax advisors on tax consequence, it might be appropriate for your needs to take some chips off the table. So you can do a partial exchange, pay some tax on a portion of equity and then do a 1031 exchange with the remainder. And sometimes with the DSTs, it's nice because you have that flexibility to get into different properties, but not having to purchase an entire property. So if you're paying tax on a portion of your equity, it might lower the amount of equity that you have to purchase something. So now you're stuck buying something that might not be as of quality. So that's kind of unique. Some of the important rules here, if you want to get a copy of this PowerPoint, we can send that over to you. Definitely reach out to our team. We can get you a copy of this 1031 exchange PowerPoint for reference. I believe it also is on our website for download if you sign up there. But you got some important rules on a 1031 exchange. Number one, you need to use a qualified intermediary or a accommodator. You can't touch your money, or that's considered a taxable event. So we are not an accommodator. We can definitely refer you out to one, but you want to set that up while you're in escrow to close your down leg so that you don't accidentally receive those funds. Second, if you want a full tax deferral, you have to reinvest 100% of the net sales proceeds. So if you sell for $2 million and you receive, just for simple math, $2 million into your accommodator account, if you want to have a full tax deferral, you have to reinvest all of that $2 million. Again, you can do a partial exchange. Just talk with your tax advisor to understand that consequence. The third here to keep an eye on is purchase equal or greater value. So if you sell for $2 million, you got to buy at least $2 million or more, or whatever that net sales price is. And so sometimes we have clients ask us, well, I'm debt free. I sold for $2 million. My $2 million went into the accommodator account. I'm going to pull out $1 million and then add $1 million of debt. So I still buy $2 million. That might satisfy the equal or greater, but what it didn't satisfy is reinvest 100% of the net proceeds into replacement properties. So there's ways to mitigate and potentially have a low tax burden on having that partial exchange, and that's where you want to explore through CPA. But we're talking about having a full tax deferral. So 100% reinvestment, and then number two, purchase equal or greater. If you do come to us and maybe you sold for $2 million and you had to pay off a $1 million debt, so now you only have $1 million in your qualified intermediary account. We do have DSTs that you can absorb that additional $1 million of debt, so that when you buy everything, you now have that equal or greater. The big one is number 4 that really affects a lot of people in 1031 exchanges, not just in our world, but in the general real estate world, and that is identifying your properties within 45 days of you closing that down leg property. That's a month and a half. When you're buying commercial or investment properties, there's arguably more due diligence that you have to do than if you're just buying like a single family house or a primary residence. So not only do you need to hire professional companies to come out and do property condition reports, environmental reports, appraisals, maybe doing lease audits, having legal teams negotiate PSAs. it generally not, there's always an exception to the rule, but if you're putting a property under contract in the, halfway through your 45-day time frame here that you need to pick properties, you could go past your 45th day and find something wrong with the property, and now you're stuck with that, or you're paying taxes. And so the nice thing potentially for people with the DSTs is you have all that due diligence done. You can then review it all. You can review all these third-party reports, all the financials. It's there. It already, the DST exists. And so that is a unique thing about the DSTs is with that 45-day, so that you don't get in trouble of passing your 45th day. This does bring up another interesting way. Some people looking at DSTs, this is not their primary option. They might be looking at it because they might have their primary goal to buy something and own it 100%. But you still are exploring your options. You're curious about DSTs. So for that investment group, the way we've worked really well with them is either covering the exchange, which I'll explain here in a second, or doing a backup ID, because you might find a perfect property. Let's say you were in a $5 million exchange. You might find a perfect $5 million or so property, but it's going to take you 3 weeks to get through due diligence and legal and everything. So what happens if you find the skeleton in the closet? Well, we can give you a DST as a backup plan. So now you have a backup plan that you don't have facing a large tax consequence, or just a backup plan so that you could tell the seller, I'm not forced to buy your property. I have a backup plan. They might play ball with you a little bit more on your renegotiations. Second, on the cover that I mentioned, if you have a $5 million exchange, I'm gonna guess it's gonna be difficult for you to find an exact $5 million property that falls within your criteria. So what's gonna happen is you're either gonna buy something more expensive, take on debt, or have to add a bunch of money into the exchange because you found a 5.5 or $6 million property, or you're gonna find a property that's $4 million, less than $5 million, and now you're looking at a small tax consequence of whatever you don't cover. So you can use the DSTs to give you flexibility. If you have a $5 million exchange and you can go out and find a property for $3 million, you can go out and find a property for $4 million, but you just know you have the DSTs for that coverage, that delta. So that's a really neat way that we've worked with, investors that are still active investors. People looking for passive, you have two options. If you're just tired of managing, which is the vast majority of our investors, what you want to explore as a passive investor is either DSTs, or you have triple net properties, which I'll dive into in a second too, of the potential risks there. But before I do that, what does like-kind property mean in a 1031 exchange? It refers to the nature or character of a property, and that it must be held for productive use in trade or business or for investment. So, ultimately, if you're doing a 1031 exchange or selling and avoiding capital gains, it can't be your primary residence. There's some other shelters for that you can consider with your tax people, but the 1031 exchange is for investments. So you're selling it also doesn't mean if you sell an office building, you have to buy an office building. It's that use, it's that investment use or business use. So you can sell an apartment building and exchange it for land, or land for an industrial, or single family rental for a duplex, or multifamily. So I just like to make that clear, because sometimes when people are searching for properties, they're just, they limit themselves because they're only looking for an exact type of property or asset class. So what is a DST? It's an entity used to hold title to the real estate. Kind of similar to like if you guys have a LLC that holds title to your property, but then there's owners of that LLC, or like a family trust where you have a family trust and then all the underlying owners are beneficial owners or at a percentage. So same thing with the DSTs. You would be a beneficial owner of that particular DST, dependent upon how much you invest in that. but there is an underlying piece of real estate in the DST. So if you went and pulled title on that property in the county or state, you would see that it'd be the entity of the DST as the owner. Unlike most entities, when you're doing group investments, the DST qualifies as like-kind property for a 1031 exchange. So it allows investors to come from all situations into the DST as undivided, beneficial owners. Then it allows, when that property has a liquidity event, or say that DST sells 5 years down the line, for all the investors to go their own way. That's the big difference, where in a lot of partnerships or real estate crowdfunding, after the investors go in, once that property sells, they got to stick together or there's gonna be a tax consequence. So the DST structure has been approved by the IRS as for the purpose of 1031 exchange compatibility under IRC Revenue Ruling 2004-86. So it's got an actual revenue ruling, which is nice. DSTs are prepackaged, ready to go. So they typically take about 3 to 5 business days to close in. That's why, as I was mentioned earlier, you can, kind of dive into those DSTs that kind of spark your interest, fall in your style box or goals and objectives, and start reviewing everything right away. It doesn't necessarily, it could, it's at your own pace. It doesn't necessarily take 2 months to get through due diligence. Because most of the time in due diligence on the real estate aspect, the reason why it takes time is because you're waiting for a third party to get you that report back. So some of the types of properties that are inside DSTs, from a terminology standpoint, when I say the term sponsor, that's like the institution that creates the DST and manages that particular business plan. So we work with 30 plus different sponsors. Some of these are some of the largest institutions in the world, big REITs, things like that. So some of these sponsors or managers you might recognize once you do a little research, but different sponsors might specialize in a couple different asset classes or a couple different strategies or geographical areas. But we typically have a lot of options within the multifamily, net lease properties, healthcare, self-storage. Then, like I said earlier, industrial properties, multi-tenant retail, but we have stuff that has leverage, we have stuff that's debt-free. So, a couple different options there. Before I dive into just, quickly some visual options, I do like to always touch on that other passive option that we were talking about. A lot of our investors are considering triple net properties or the DSTs because they both bring a passive nature to them. The biggest difference is DSTs are 100% passive to the investor outside of doing your taxes, your annual taxes. Where a triple net might appear, or a net lease structured real estate might appear passive, which it usually is a lot more passive than probably your multifamily or your whatever you're selling. So there's probably less headaches, but you're buying a property that has a lot of concentration risk. You're buying a property that probably has a level of asset management. I mean, with one of our other entities, we manage, hundreds and hundreds and hundreds of millions of dollars of net lease properties. And we have an entire team. If you came to our office, and you went to our second floor, you got accountants, lawyers, asset managers, CFO, and it takes an army to manage the day-to-day of or week-to-week or month-to-month of a net lease, because these big tenants, it's not always that they are just paying for everything. They might be on a reimbursement schedule, so you still may, depending on the triple net you buy, but you still may have to, organize certain maintenance repairs and then submit invoices and chase them down, or big corporations always make mistakes on sending rent or sending it to the old owner or something along those lines, and you're battling, for 2 months to get everything redirected. The biggest thing I see, though, because I do understand that these are a triple net property, if you just bought one on your own, is more passive than what you probably are currently managing. The biggest thing I think is investors are taking that concentration risk. So they are dumping, millions of dollars into something that they for most investors have no experience in and have never negotiated a lease. So you might have a 10-year lease today, or something that's long-term, but eventually you're going to have to renew that lease, or your kids are going to have to renew that lease. Because if you buy a triple net property, more than likely to get the value back, because you lose value from a high level, you lose value every year that lease term burns off. So if you started with 10 years and that went down to 6 years, it's probably worth less. There's an exception to every rule, but statistically it's probably worth less. So where do you get your value back? On that extension of the lease or re-tenanting the building. That's where you can potentially get that value back. And so there's other things that can bring value, of course, but that's just kind of net lease 101. So you're going to hold these long term, or you're going to pass these on to your kids or your heirs and leave them with the mess, but you're going to have to renegotiate that, or you're going to have to re-tenant it. And re-tenanting could cost hundreds of thousands of dollars to millions of dollars, depending on how big the property was. You're going to have to pay leasing commissions. You're going to have to probably sit on a vacant building for 1 to 2 years, because commercial buildings just take longer. And you're going to have when I talked about the money that it takes to re-tenant, the tenant improvement allowance for these national tenants, you really want to just understand all that. And it could work out perfectly. And maybe someone who has experience doing this, they're fine with that risk. But a lot of people just are not aware of that. So people like triple nets because they have someone like FedEx on the lease or some national tenant on the lease, which does potentially bring some value or some stability. But what we do in the DSTs is we still mix triple net type buildings or net lease type buildings in there to create that stability of potential cash flow. But we can also still add in other asset classes like multi-tenant industrial or multifamily, or multi-tenant centers that maybe have potentially more meat on the bone, because you can get in and be an active manager. You're not just stuck in some 10 or 15-year lease, and actually increase rents and create value, and not have to wait for an entire 10 years to create value. But we kind of create that sample portfolio and reverse engineer from there to see kind of what might make sense for you. So the moral of the story is, I think a lot of people that are just buying a triple net, they're going to face some hard decisions in the future, or their heirs are going to face some hard decisions. I hear it every day. I mean, we have someone that's bought a net lease property and they just are kind of tired dealing with the tenant. This is a big national tenant that a lot of people consider to purchase. Don't want to say the name on this webinar, but big net lease. A lot of people buy this tenant as a net lease because it's in the healthy kind of $1 to $4 million price point, and they've owned it for, don't quote me exactly, a couple, 4 or so years, and they're just tired dealing with the shenanigans that these big corporations do, and now they're selling it at a loss, $200,000 loss, because it only has a handful of years left on the lease, and they don't want to take the risk and have the headache of renegotiating the lease, so they're just willing to let go and potentially consider DSTs. So some examples, we have stuff like multifamily. This deal was a multifamily outside of Nashville. Been a great asset so far. Obviously no guarantees. It is fully subscribed, but just to give you an example, this, DSTs give you access again to like a multifamily deal, kind of in a net lease structure, because you're not having to deal with it, but you could probably, like our investors that are multifamily investors, you could look at this and understand it, because this is what your profession was. And we're obviously there to walk you through things you might not understand, but we do a lot of, FedEx properties, medical stuff. This was another brand new 2020 construction in Texas of multifamily, Amazon distribution centers. And so the DSTs, again, are just designed to create no more day-to-day management. Again, the only thing you're worried about is your annual tax requirements of filing your taxes, but you're not having to deal with any of the headaches, the tenants. There's professional asset management. It allows you to, concentrate on why you're becoming passive in the very beginning. But more importantly, I think spreading that risk out, every other area of our financial investing, we've typically taken the approach of diversification, right? When you show up to a wealth management firm, I'm not giving advice here, but you show up there, typically they're not going to go, oh, you have $1 million to invest, let's put it all in Google, or let's put it all in this company. They're going to create some sort of portfolio for you dependent upon, your age and your goals and objectives. But for some reason in real estate, everybody is highly concentrated and they don't take that same approach. So the DSTs, for people who want to consider that diversification, it's a great potential tool there. And the reason why is because minimum investments are low, $100,000. I know that most people on an exchange have much more money than that, but it allows you to diversify the minimum. Also, you can do cash investments. These are not just for 1031 exchanges. The unique thing with cash investments is you could do an investment into a DST as a cash investment. Then when it sells down the line, you could then do a 1031 exchange. So that's kind of a unique way to defer, capital gains on a cash investment. So usually in the debt side, this is very important because people like to take on debt for depreciation purposes. That's a big buzzword over the last few years because of all the advantages that the tax code has provided for on depreciation. But if you show up to us and you have zero debt, we're going to walk you through the risks of taking on debt. But you might have sat with your CPA or legal team and realized, it would be nice if I had taken on a little bit of debt so I can get some new depreciation created for tax efficiencies. We can do that in the DSTs. We just want you to understand that risk. But the nice thing is with the debt on most DSTs, it's long-term financing and typically 100% non-recourse to the investor. So you still have risk to lose your investment, but it's non-recourse. You don't have to sign on the loan documents. This is the trustee, the sponsor working through that. So it's a very easy process. If you need to invest in a DST with debt, you can still close in 3 to 5 business days. You don't need to produce all these income documents and qualify for the loan and all of that headache that we've probably all experienced. The sponsor's already done that previously and locked in the debt, and you get the pass-through benefit. We also have deals that are debt-free, which we'll get to in a second on why you might consider that. But the question we have often is, do DST properties, if they have a loan, is it amortizing debt? And how do you get your portion of the pay down? So if there is amortization, which we do have loans that have amortization, some loans are interest only, but we can walk you through that. It's something that's already predetermined and fixed. But you would get your pro rata portion of any principal pay down. Typically our leverage is 35 to 60%, but if you have a higher loan to value, we have some unique ways to potentially cover that. So definitely reach out to our team. When a DST is sold, can you do another 1031 exchange? So the answer is yes. When a DST property is sold, assuming the 1031 exchange is still available in the tax code, you can then do another 1031 exchange, and you're not necessarily stuck in DST land. If you're in a normal DST and it sells through the open market 5 years from now, 7 years, whenever the sale is, you can go buy your own property at that time. You can pay your taxes, or you could do another DST. We do have DSTs. The big buzzword around town nowadays is the 721 exchange. That's a different strategy, but if you have interest in the 721 exchange or want to learn more, ask us about it. We have a whole webinar on that on our website that you could take a look at. How does a DST property work in regard to potential distribution and appreciation? When this property is sold, any of the net appreciation is 100% investor-owned money. So you get your pro rata portion. All the investors are treated equally, so it's not like a LLC or partnership where a certain group of investors get maybe a higher preferred return than the others, or they're paid first. Everybody in a DST is an undivided owner. So you could be a 1% owner and then someone else could be a 15% owner, you're still receiving the same pro rata of any rent and or appreciation. Do you receive a K1 at the end of the year for tax purposes? In the DST structure, no. You're more going to receive something like a substitute 1099 and then a package that has like a balance sheet, and essentially you could bring this to your CPA and they could plug it all in. If you do need any help with that, we will not do your taxes, but we do have access to people who understand the DST structure. We can put them on the phone with your CPA and they can speak the language together. So, definitely ask us about that. We can also give you a sample tax reporting. So why would you consider an all cash or debt-free DST property? So the big thing to understand is on our platform, we have debt deals and we have deals that are debt-free. Obviously, in a debt-free deal, you mitigate risk. Tax efficiencies, you may have tax efficiencies, but if you're fully depleted, they might not be as tax efficient for you. But it really just depends on what your goals and objectives are. And that's why talking with your CPA and understanding, if I go in this debt-free deal, what will my, actual yield be, or my cash flow after taxes versus going in one with debt. And then if you consider the one with the debt, maybe you are getting a higher yield technically. Is it worth that risk? So, everybody is in a different stage of their life or different lifestyles. And so we will always recommend that staying debt-free is the most conservative way. Obviously, there's always risk on the real estate still, but not lender foreclosure risk. There's no refinancing risk. A lot of people in today's world are facing refinances. So they're either having to refinance and take a substantially lower cash flow, or they just can't refinance and they're having to fire sell an asset at potentially a loss. No cash flow sweeps. I think this is a big one in unstable markets. So if you have a loan on a property, a commercial property, there's usually in the loan document some sort of cash flow sweep provision. And that essentially says that, it could say if there's a downgrading. So you could be in a net lease property, you have a debt on it, and for whatever reason, their credit rating downgrades. Maybe it's just market conditions. They're, struggling, but they're still alive. They're not going out of business. They're still paying their rent, but they get downgraded. Or mergers and acquisitions. A lot of times in a merger with these big tenants, they might get downgraded temporarily because of the merger. So with all that said, you could end up getting a cash flow sweep. So really, whenever you're investing in any deal, even with us on a DST, you want to understand what those cash flow sweep risks are. That's also why you diversify, so that if a cash flow sweep happened, you didn't have all your money in that one deal. It gives you, I think the most important thing with debt-free, outside of the obvious of not getting a lender foreclosure, is that you have staying power. You can sell and wait for an appropriate market cycle, or you could sell earlier than you thought. A lot of times if you have a loan on a commercial property, if you sell too fast in the first couple of years, you might end up having a penalty because of prepayment penalties or defeasance, yield maintenance, etc. So it gives you a lot of flexibility each direction, which is kind of nice. If you take on debt, this is the biggest one. If you take on debt, you're kind of stuck in that world, because on a future exchange when that sells, you're gonna have to replace that value, replace that debt component. So a lot of people that I've talked to, they'll be like, okay, I want to chase the debt now. I'm at an age where I could take the risk. I want that tax efficiency, and I would just say, okay, did you talk with your CPA? Also, in 7 to 10 years from now, are you going to be in that same mindset of you're okay with debt in 7 to 10 years? Because a lot of people have worked to pay off their debts, and then they get to a certain retirement age and they don't want to have that lingering debt. But once you take on debt, if you add debt to an exchange, again, not good or bad, I'm not selling you against it. I just want you to understand that in 7 years when that DST sells, you're going to have to maintain that debt. So just be aware of that. And as we wrap this up, a few other items or announcements. Definitely register on our website. I'm assuming you have a password, but reach out if you need an updated one. Keep an eye out for our emails. I know, you might get a handful of emails every month, but we try to provide valuable information on those. Big thing coming up, and I think toward the end of April, we're going to announce the date soon. We have a big investor day. This is not just for current clients, but also people considering it. It's going to be a very large conference. The first one is going to be here in Southern California in the Los Angeles area. We're going to have it at a Marriott hotel, it looks like. So big kind of convention center, but there's a hotel there. So investors that are coming from out of state, there should be rooms available to stay there. We encourage that. It's great to meet face to face with our team, but the most important thing is at that investor day, we're going to have some of the large sponsors. So these people that are managing these deals, they're going to be attending there, that we're going to be doing panels. And I think it'll just be a lot of great information. This is not a quote unquote for-profit conference. This is to educate and allow for additional questions and allow for you to be in front of our team, but it's free of charge from that standpoint. So I'd love to have you guys there. We do every week have these different topics on Wednesday. On Friday, we do a shorter conference call, and on there, we do a different topic every Friday, and those will be rebroadcast on our podcast. So if you go on Apple and download our K Properties and Investments podcast, you'll get a lot of past recordings of interesting information. So again, we really appreciate everybody's time, continuing to stay on our website for updates, looking at the property inventory. It's a great opportunity to just stay in touch with the market. And if there's anything that we can do for you, let us know. We can do scenarios for you that you could take back to your CPA to review. And we appreciate. My direct line, if anybody would like to talk with me, is 562-882-7617. But you'll find all my contact info on our website at www.kpi1031.com. Thank you again.